Hello, everyone. Today, we dive into the fascinating world of compound interest, which the great Albert Einstein himself dubbed the eighth wonder of the world. To grasp this concept, imagine a seed planted in fertile soil. Initially, it might seem insignificant, even negligible. Yet, over time, with proper care and the right conditions, this tiny seed can grow into a towering tree, spreading its branches in all directions and even bearing fruits that in turn plant more seeds. This process of growth, expansion, and multiplication mirrors the power of compound interest in the financial realm. Even a modest initial investment can grow exponentially over time, far surpassing what one might anticipate, thanks to the silent but relentless force of compound interest. Curious to learn more? Well, that's precisely what we're about to delve into. How a simple beginning can lead to extraordinary results. So stay with us, as understanding this concept might just reshape your perspective on money and investment. And if you enjoy content like this, don't forget to subscribe, hit that like button, and turn on all notifications so you don't miss our upcoming video. Have you heard about compound interest and are wondering how it works and how to leverage it? No worries, you're in the right spot. To truly grasp it, think of compound interest as a silent ally working behind the scenes for you. You know, kind of like those board games where the goal is to build an empire by purchasing properties and collecting rents. Except here, it's real life, and the stakes. Your financial future. You start with a small sum, perhaps $100, and that's where the magic, or rather the math, begins. You might be astounded by just how impressive the results can be. Let's take this as an example. You deposit those $100 into a savings account that offers a 5% annual interest rate. After 1 year, you don't have $100, but $105. Okay, an extra $5, no big party, you might think. But wait, the real marvel is yet to come. The next year, your interest isn't calculated on the initial $100, but on the $105. So, you earn $5.25 in interest, and you end up with $110.25, and this growth persists year after year. Now you might be thinking, how's that different from simple interest? With simple interest, your money's like an athlete running the same track lap over and over, at the same speed. With compound interest, it's as if the athlete speeds up with each lap. Initially, the difference is subtle, but give it enough time, and compound interest becomes the Usain Bolt of your financial portfolio. Indeed, the true wonder is that the longer you let your money work for you, the more that initial sum grows. To really visualize the impact of time, consider this. Suppose you invested $1,000 at a 5% compound interest rate. Without touching this amount, after 10 years, your investment would be roughly $1,629. After 20 years, it would have climbed to about $2,653, and after 30 years, you'd be looking at nearly $4,322. Impressive, right? This perfectly illustrates how compound interest, combined with time, can amplify your capital. Every additional year offers growth, which in turn is applied to an increasingly substantial sum. It's like a snowball effect, gaining speed as it rolls downhill. And you're at the top, watching your future take shape, brick by brick. You see the potential now, don't you? This hidden power that can turn a modest stash into a treasure over time. It's both exhilarating and comforting. But the big question remains, where to begin? The journey's enticing, but how do you genuinely get started? It all starts with the initial capital, that sum you're going to invest for the first time. Think of it as the seed you plant in a garden. The bigger and healthier it is, the better its growth prospects. So, saving up for this initial investment is vital, even if it's just a few $100s. It's your entry ticket into the thrilling world of compound interest. And you don't need a vast sum to kick off, every dollar counts. However, a question might be lingering in your mind. Where should I place my money to benefit from this amazing phenomenon of compound interest? Great question. If you're new to this, it's best to prioritize simplicity and security. Compound interest savings accounts are an ideal starting point. Let's put things into perspective. Suppose you've set aside $1,000. You're looking into where to invest and come across 3 bank offers in your neighborhood. Bank Alpha offers an annual interest rate of 1%. Bank Beta provides a 3% rate. And Bank Gamma, the market leader, boasts an attractive rate of 5%. If you placed your $1,000 in each of these banks for 10 years, without adding any extra money, here's what would happen. With Bank Alpha, your capital would grow steadily, and after 10 years, you would have accumulated roughly $1,105. Bank Beta, with its more competitive rate, would let you watch your investment rise to approximately $1,343 over a decade. As for Bank Gamma, this is where your money would work hardest for you. At the end of these 10 years, you would have no less than $1,629. Impressive, isn't it? A simple difference in interest rates can lead to significant variations over the long term. Now, for the more adventurous souls, there are other options. You might consider mutual funds, certificates of deposit, or even try your hand at the stock market. But remember, with greater potential gains also come greater risks. To start safely, a good old savings account is a solid choice. Do your research, speak to experts, and find the option that best fits you. Building on that momentum, once you've found a safe spot for your money, you might wonder how often the interests are added to your initial capital. This is where compound frequency comes into play. It could be the small detail that makes your investment even more profitable. So, how does this compounding frequency genuinely impact your investment? Let's dive into a concrete example to understand. Consider a yearly compounding at 5%. Here, your $1,000 would grow smoothly, reaching $1,050 by the end of the year. Straightforward and predictable. But what if instead of waiting until the year's end, your capital got a boost more frequently? Imagine every quarter, a small interest gets added, equivalent to a fourth of that 5%. Your capital would thus be rejuvenated regularly, and by year end, it would slightly surpass the $1,050. What if we took it further and had interest added monthly? Every month, your $1,000 gets a small boost, rising bit by bit, eventually outstripping the growth offered by quarterly compounding. Starting to see the pattern? The magic lies not just in the interest rate but also in how often it's applied. This nuance might seem subtle, but it has the potential to notably change your gains over time. So, as you continue your research, keep an eye on this compounding frequency. At this point, you might think it's time to sit back and watch your money work, right? Well, not so fast. True finance masters know there's always room for further optimization. Let's delve deeper together. First, let's explore the potential of variable interest rates. In today's dynamic economy, interest rates can fluctuate, sometimes offering golden opportunities for the vigilant. If you had placed your initial $1,000 investment in a fixed-rate savings account at 5%, with a variable interest rate account, there are times you might benefit from a much higher rate, thus enhancing your returns. Many have taken advantage of such periods to fast-track their investment growth. Of course, there are also times when rates might be less favorable, emphasizing the importance of keeping an eye on the economic landscape and adjusting your strategy accordingly. The trick lies in the art of seizing opportunities while staying aware of the risks. But that's not all. Let's now talk about additional contributions. You've probably heard the saying that every little bit counts. Well, in the world of finance, this has never been truer. Suppose that every month, you added a small amount to your capital. Even something as modest as $20 a month can make a massive difference. In 1 year, that's an extra $240. Over 10 years, without even considering the interest, you'd have added $2,400 to your investment. With compounding, this amount could easily double or even triple. The key here is patience and discipline. Compound interest is a powerful ally, but consistent effort and long-term commitment can truly elevate your finances to another level. By combining these techniques and staying true to your strategy, you're setting yourself up for a bright future. That said, even armed with all this knowledge and tips, it's vital to remain cautious. In the world of investing, some common mistakes can seriously hinder your financial progress. Let's look at these pitfalls to ensure you steer clear of them. First, let's discuss premature withdrawals. You might be tempted, faced with an unexpected expense or an enticing opportunity, to dip into your investments earlier than planned. It's understandable, but every time you make a withdrawal, you disrupt the magic of compounding. For instance, after investing for 5 years, you decide to take out a small portion. What you're losing isn't just that amount but all the future interest that amount would have generated if it remained invested. A withdrawal might seem harmless, but in the long run, it can be costly. Next, never overlook the risks. Every investment carries risks, some more than others. For example, a savings account is typically seen as safe, while stocks can be highly volatile. But remember, high returns often reflect high risks. It's essential to fully understand where you're putting your money and to be comfortable with the associated risk level. Don't get lured in solely by promising returns without assessing the risk. Investing blindly is akin to sailing the high seas without a map or compass. In conclusion, investing is a bit like dancing. Once you know the basic moves, you can have fun and improvise. But always keep an eye on the floor to avoid tripping. With a solid strategy and consistent attention, your financial journey will be as thrilling as it is rewarding.